Good morning and welcome to this Monday, September 19th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it is Fed week. We're going to hear from the Fed on Wednesday. Their two-day meeting begins on Tuesday, so that'll begin tomorrow morning. And 2 o'clock on Wednesday, we will get their latest decision. Market essentially is pricing in a 75 basis point hike, but there are more and more folks in the camp of raising 100 basis points, especially given last Tuesday's hot CPI report that came out for August. So we'll see what happens. Personally, I think the 75 basis points is baked into the market. I think if they raise 75, kind of just remain status quo, data dependent, that sort of thing, I think the market probably takes that in stride. I'm not so sure about 100 basis points, though. I think if they were to pull off the 100 basis point hike, I suspect the stock market would sell off. And I just say that not so much because rates are higher, but because I think the market, when I look at a lot of the intermarket relationships, I still see a market that doesn't believe that inflation is here to stay. And so any kind of a move on the Fed's part to appear as though they're taking it more seriously, and listen, I'm not trying to say inflation's not serious, don't misunderstand me, but the stock market builds in expectations of what it thinks the Fed is going to do. And I think part of this move down the last couple of months has been the result of the Fed saying that they were data dependent. When we started getting some data that looked disinflationary, they ignored it and kept raising and kept talking tough. Then, their wording was, okay, well, it was just 1 month. Yeah, the data was, disinflationary, but it was just 1 month. We need to see more than that. And so I think there's just a little disconnect right now with what the market's expecting and what the Fed's doing and saying. And my belief is the stock market is going down more because it doesn't, I don't know if like what the Fed is doing is the right terminology, but it maybe doesn't trust the Fed, or just the credibility of the Fed is at stake, something along those lines. And I just say that based on the way the intermarket relationships are working and looking. Because if you think that the stock market has got a lot of inflation problems, gold should be soaring. It's not. The 10-year Treasury yield, yes, it's going up, but is 3.5% Treasury yield enough for a 6 or 7% inflation rate? I wouldn't think so. Normally, you build it in expectations of future inflation into what you're willing to accept in terms of yield. So there's a lot of dynamics going on this week. And personally, I'll be looking to see not just whether the market goes up or down, but I want to look at these intermarket relationships to see what the market truly believes is happening. We're going to get off, looks like, to a rougher start this morning. We've got the QQQ pre-market trading down about 0.8%. The Spider pre-market trading down about 0.6%. And the diamonds also trading down, they're down roughly about 2/3%. So all in that 0.6 to 0.8 range. The 10-year Treasury yield this morning did go up and hit 351 this morning. So that was an 11-year high. It has come back down. It's relatively flat now. We're sitting at 3.467%. I think that's helped a little bit with futures. Futures were down more overnight and earlier this morning, but we have seen futures come back a little bit. So I think some of that has to do with the fact that the 10-year Treasury yields pulled back. But again, all eyes are on the Fed. Looking at economic reports over the next couple of days, and I'll tell you what, I'll get to that in just a minute. Let me go ahead for those of you who are new and just quickly take you over to earningsbeats.com. And I just like to make sure everyone who listens to the show is aware we do have a free newsletter, Earnings Beats Digest, published 3 times a week. I usually write really brief articles, a couple paragraphs in a chart, so you can digest it pretty quickly. Try to make it educational. Some of the things that we look at earnings beat. So we're talking about earnings gaps, candlesticks, relative strength. This morning, I did an article. I did a pair, looking at two different companies. It was actually Pepsi and Coke, comparing one to the other. Because a lot of times you look at a Pepsi chart and you look at a Coke chart, and they might look the same. They might both be going up or both be going down. You can't really see which is leading the other unless you put it on a paired chart where you have something like PEP colon KO. So if that's going up, then that's telling you Pepsi's outperforming Coke. If it's going down, it tells you the opposite, Coke's outperforming. Anyway, I wrote an article over the weekend and talked a little bit about pairs. I think that was in the Don't Ignore This Chart blog, and indicated that I would discuss one in the EB Digest this morning. So I looked at Coke and Pepsi. You might be surprised, Pepsi outperforming Coke over the last decade. So some of you might have different tastes between the two, but Wall Street's taste is pretty clear. Pepsi's been the choice for the last 10 years, although Coke in 2022 has done better. So really just depends a little bit, I guess, on your time frame. Anyhow, if you do subscribe to the EB Digest, it's just little old nuggets like that, try to pass along just to hopefully improve the way you look at the market. Maybe add a few tools to your trading toolkit or investing toolkit. I think it's really for both traders and investors. But go over to earningsbeats.com, scroll down, you'll see an area where you can sign up. Name and email address is all it takes. No credit card required. Let's jump into the market recap from Friday. Dow Jones Industrial Average was down almost 0.5%, down 139 points. Back below, well, it already was below, but it's clearly below 31,000 right now, so it's below that latest round number. S&P 500 fell 28 points. And this was kind of big because we lost 3,900. Back on August 27th, which was a Saturday, we did a free event. Where do we go from here? And the timing was actually, we scheduled it well in advance, but it turned out that it was the day after Fed Chief Powell came out with his more pain ahead speech from Jackson Hole. And the market absolutely tumbled on Friday. So the timing of that Saturday event, and actually some of the things that I talked about, completely changed. I mean, the market's always changing. The dynamics are changing. The technicals are changing. Price action changes. And so as a technician, you have to be able to absorb everything being thrown at you and come up with your latest prognostication. So anyway, back on August 27th on that Saturday, I thought after we had the breakdown on that Friday, after the Jackson Hole speech, I saw two possible scenarios unfolding. One was we go back, we test the 3,900 level on the S&P 500, and we bounce off of that. And from there on out, market goes higher. The second one was that we lose 3,900, which brings into play the June low, and we go down for a double bottom or something around a double bottom. And I think the Friday action, if nothing else, opened up that possibility, made it much, much more possible. I would even say at this point, probably likely, I don't know if that's a word, probably, or a phrase, probably likely. I don't know exactly what that means, but you got to break below 3,900 before you get to 36.36. I mean, that part's clear, and we did that on Friday. Now, I was, when we gapped down, I thought, okay, here we go. We were down quite a bit intraday, and you can see we rallied back. So the market's always throwing us a curveball. Looks like a little bit of a hammer, but now we've got futures down. I would say this, if we go down below today where we were on Friday, I just don't really see a whole lot holding the market back. I do think the odds are now with the bears that we're going to go back and retest. Do I think it's 100% guaranteed? No, I don't. I would say maybe 55, 60%. I don't think the low's in. I don't know, just with the Fed meeting, and especially if the Fed says 100 basis points. If they say 100 basis points, all bets are off, because I really think the market's going to be more upset about the credibility of the Fed than it is going to be about the higher interest rates or the inflation possibilities. So anytime the market loses confidence in the Fed, we can see a very, very quick swoon. So let's see what happens on Wednesday. I think obviously that's going to be critical. How the market trades up to and just after that report is going to be really important as well. But there's no doubt moving below 3,900, which had been a support level that I could point to many, many times going back into May. The gap down from 3,900 in mid-June, the recovery up near that 3,900 level. We also had the gap support at 3,921. We just recently went down to 3,900, held, went up 200 points. I mean, when you get that many attempts at a key support level like that, or that many tests, when you lose it, it's a big deal. And we lost it on Friday. So there's no sugarcoating that. Yeah, it was a nice afternoon recovery, but we still closed below it. We've got futures down again today. Bears are in control here short term. Get back up above 3,900, then we've maybe got something else to at least think about or talk about. But in the short term, bears are in control here. NASDAQ down 104 points. That's down almost 1%, 0.9%. As we keep going down, one thing that I will point out, because I think it's been important all along, the AD line continues to be strong. That action on Friday, even though we had the big move down, we finished below 3,900. That actually was a positive for the AD line because we closed near the high of the day. Anytime on the AD line, you're closing in the upper end of the range of that trading day, your volume is going to be multiplied. And that's a little bit misleading, by the way. The one thing I tend to try to ignore on the AD lines, I wish there was a way I could filter out these quad witching days, because there's always massive volume. It's the March, June, September, and December option expiration Friday. That'll be quad witching day. It's just a lot of different index options and so forth, stock options, that'll index futures, everything that kind of expires all simultaneously. And there's a lot of repositioning. So there's a lot of volume, but it always, some people mistakenly say, oh my gosh, we went down and it was massive volume. Well, I wouldn't look at it necessarily like that, because the volume is always much, much higher on the third Friday of the third calendar month of each quarter. The NASDAQ lost 11,500, so it also lost some key area of support. Don't want to sugarcoat that either. Anytime price, support, resistance, along with volume, those are the two primary indicators for me. Everything else I talk about is secondary. I mean, if the prices are going down, they're going down. Now, I might look at some of my ratios and I might be encouraged by the ratios. I might look at the AD lines, be encouraged by the AD lines. But I would want to be clear, when you lose a support level, it's a big deal. 3,900 on the S&P, 11.5 on the NASDAQ. Both those levels lost. Not good for the bulls in the short term. Mid caps down 32. That's 1.35%. Small caps down about 2/3%. Looking at the individual sectors, staples, the only one that showed any kind of a significant advance. I don't even know if you'd call it that, up 1/4%. But staples did finish higher on Friday. Energy was the big loser, down 2.13%. Industrials down about 2.1%. Materials down more than 1.5%. Communication services down a little bit more than 1%. So here was your sector leaderboard. And as I look across all of these sectors, except for energy, they're all with a negative bearish bias and configuration. Price action below the 20-day, below the 50-day, losing recent price support. Here you got losing price support below the 20s, just crossing below the 50 or on the verge. Same goes with materials, price action below the recent low. The configuration is bearish across most of these sectors. Energy and utilities are the two that to me stand out a little bit more bullishly, even though they're both rolling over, especially you can see energy right there. But as long as it stays above its 50-day and the recent low around 76.5, 77, I think it's still okay technically. All right, talking about the 10-year Treasury yield. So mentioned the 351 earlier. Let's see where we are now. 3.475. So we were above the 348. I think now the bond market's just in sit and wait mode. My guess is there's been a lot of selling, sending the yields higher. I think if the Fed does what's expected, the 75 basis points, my guess is that we'll probably see movement back into treasuries once we get like there's been such a big sell-off heading into the meeting. I think there'll be a little bit of a relief rally in terms of prices on the 10-year going higher, which means the yield will come back down. That would be my guess. Normally we get the opposite once the news is out. 100 basis points, I'm not so sure. That could spook both the bond market and the stock market. We might see selling in both if the Fed decides to go 100 basis points. So I'm kind of, I don't know, I feel like I'm walking on eggshells talking about the 10-year Treasury yield. This is a major level right here. It's not major in the sense of, oh my gosh, the economy can't stand 3.5%. That's ludicrous. If you go back throughout history, 3.5% is not a high rate. Usually, for things to really choke out the economy, you got to be talking about 4.5%, 5% or higher. So the rate of the 10-year Treasury yield does not bother me. The direction and the fact that we've gone up so fast, yeah, that's very concerning. And I think that's why we're already seeing the market, or not the market, but the economy choked out a little bit. And I think it's going to get worse. And if you go 100 basis points, I mean, essentially what the Fed is saying is we are going to kill the economy. We are going to kill demand because that will help us in our fight against inflation. Now, again, a lot of areas of the market to me are saying, what inflation? Gold in particular. I don't know if you noticed, gold went to a 2.5-year low. Why in the heck would gold be at a 2.5-year low? If you really believe inflation was more than just, I don't even like to use the word transitory or temporary because we've now had it for a couple of years. But if you really think this is a long-term problem, money would pour into gold. And it's not. And I know a lot of folks, well, the dollar's higher. I don't care. Gold is a hedge. Gold is a major hedge against inflation. Real estate is a big hedge against inflation. And real estate relative to the S&P 500 has been getting hit pretty hard. So I'm not seeing it in terms of how Wall Street is moving their money. And so we can talk about this stuff, inflation, higher rates, all we want. But if I don't see the money supporting that theory, I just have a hard time buying into it. And you can feel free to disagree. I know many of you do. That's fine. Maybe the stock market falls completely apart. That's a possibility. I don't think it's happening. I don't think it's happening because I don't think inflation is going to be a long-term problem. And I believe the Fed is going to pivot and is going to turn much, much more dovish in coming months, certainly in 2023. And that is, lower interest rates. If you look at what's been going on with the rates going up, the market's been going down while the rates go up. If the Fed pivots, and again, some of you might disagree with me and think the Fed's not going to pivot, it's going to keep raising rates. That's what they keep saying. And they have been saying it. I'll definitely agree with that. A lot of times the Fed says things they don't end up doing, though. But my belief is if the Fed pivots, and I believe they're going to, and rates begin to come back down, the stock market's not going any lower. It's just not. We'll see. And I think the battleground is now. It's not, well, let's see what happens next month or in November or at the end of the year. I think it is right now. I think it's starting with this Fed meeting this week. If we don't go down to a new low on the S&P 500 between now and say the first week of October, I already don't think it's going to happen, but I will acknowledge losing 3,900 on the S&P definitely opens up the possibility for 3636 on the as a possible retest of the June low. I don't think we're going to get there. Like I said earlier, maybe a 55, 60% chance that's where we're going. I still think it's a pretty sizable chance we don't. I don't believe we're going below that. I said earlier, I think that June low is our bottom. Will we retest it? Possibly. That one's a little up in the air. I think, though, this week is going to be big. If we're not selling off after the Fed meeting, if we see a rally after the Fed meeting, I think that's it for thinking about the bottom. We'll see. Could be wrong. S&P 500, there's that chart. There's the breakdown. Look at that hammer that prints off this downtrend. Normally off a hammer, though, you're going to get a gap up. And it does not seem as though we're going to get that today. Let me give you, we've got about 10 more minutes to go, but let's take another quick look at the spider, see what's doing pre-market. That's down 0.7. We're seeing a little bit of weakness as we head back toward the open. The Q's about 0.9%. So we'll see whether or not we hold. Whether the open, we see more selling throughout the day, or is it going to be another one of these gap downs where we rally back later in the day? The NASDAQ 100, there's your top back in August. Here's the move lower. Again, we broke down actually on Thursday on the NASDAQ 100 and then continued the move on Friday, but with a nice hollow candle. One thing that we saw back here at these bottom, even at this bottom over here, you can see a lot of hollow candles or long tails. Yes, you're moving lower. Yes, your portfolio, if you're long, is going down. But the manner in which you go down is important to me. If you go down and it's these big swooshes with big red filled candles, that is distribution. And that makes me very, very nervous and much, much more bearish than when you're gapping down and then seeing buying later in the day. To me, that's a sign of manipulation followed by accumulation. Big red filled candles, there's no manipulation, there's no accumulation, there's just flat out selling. So the nature of the move to the downside is important to me. As we look at the sectors, what I did here is I just pulled up the S&P 500 over the last 3 months. So if we look at the S&P, we're in mid-September. 3 months ago is mid-August, mid-July, mid-June. So right as we went down here and put in this low, this is June 16th, 17th. This was September 16th. So that right there is the 3-month period we're looking at. The rally and the move back down. Now we're getting fairly close. We're back closer to the bottom than we are the top. And when I look at the sector summary to see what has happened during these 3 months, where is Wall Street positioning? It's a confusing leaderboard, to say the least. I mean, consumer discretionary leading immediately, I think, bullish thoughts. It's like, wait a minute, the Fed is trying to kill the economy. We're probably already in a recession. I think we are. I mean, 2 negative quarters of GDP. The Fed keeps raising rates. It's going to slow demand. Look at crude oil prices. Crude oil prices, by the way, down another $3 today per barrel. It's down to $82 a barrel. It was 130. It's 82. And that's not the only thing. I mean, you look at gold, you look at steel, you look at silver, you look at copper, you look at iron ore, you look at lumber. I mean, all these prices topped many, many months ago and have been coming down. It looks like demand, to me, has already slowed in a lot of areas. And yet, consumer discretionary is leading over the last 3 months. The stock market, for whatever reason, is maneuvering and moving back into discretionary. Discretionary was pummeled during the first 5 or 6 months of this year on a relative basis. And that's part of my theory. The market's built it in. And now, in my opinion, the Wall Street's been repositioning back into discretionary as prices have rolled over because they believe the Fed is going to pivot. Rates are going to come down, and these growth stocks in the consumer discretionary area are going to do better. But then you look at the next one. The first one, I would be very bullish. Then I look at the second one, I'm like, utilities. Wait a minute. I don't want utilities. I don't want money rotating into utilities. The only thing I can say here is maybe for the same reason, the market is anticipating the Fed to pivot and rates to come back down, making the dividends and utilities more attractive. I don't know. Maybe that's why financials are third for the same reason, the dividend aspect. I look at this and I'll tell you, I'm a little confused because you got technology way down here, which if technology and utilities were switched and I saw this, I would be extremely bullish. But what's going on with technology? What's wrong with semiconductors? I'm bracing for warnings in the semi space here this week. I mean, they have been so bad technically. There's got to be bad news coming out of the group. And so don't be surprised if you wake up one morning and NVIDIA or AMD or maybe both have warned. That's a major risk. I mean, that group, and I think when they warn, that'll probably be the bottom. I imagine we'll see a big gap down, and then we'll probably see rally off of that. Something's going to happen, though, in that area of the market. I mean, if I pull up the technology group, look at semiconductors. So over this area, or over this time frame, semiconductors have been down 2% while the market's rebounded. Semiconductors usually lead. Look at software. They've gone up, but barely. They're both lagging the S&P 500. It's hard to get, even my argument, and I've been pretty bullish for the last few months. Just my overall strategies just changed because of the way money is rotated. Well, in the last 3 months, this is not supporting my argument at all. So yeah, I want to see software and semiconductors begin to move. Renewable energy, on the other hand, wow, what a move. 96% in the last 3 months. Computer hardware, Apple, rebounded pretty nicely off of that June low. So we do have some positive areas, also some weak areas. Let's talk a little bit about some of these ratios because they're mixed as well. I always like to talk about the ratios. When we went to this bottom down here, one of the reasons why I thought the market was bottoming was because Wall Street was repositioning. As we went and set a new low, if you look back, every one of these S&P lows in 2022 saw the XLY XLP ratio, consumer discretionary versus consumer staples, set new lows as well. Lower low, lower low, lower low, lower low, lower low, lower low. When we got to this June low, a decidedly lower low in price action for the S&P, the XLP or XLY XLP ratio did not go to a new low. Same goes for the QQQ versus the spider. QQQ is more growth oriented. Lower low, lower low, lower low, higher low in June. Here's that June bottom. So all of a sudden, money's rotating into the NASDAQ versus the spider. Same goes with the IWF IWD, which is large cap growth versus large cap value. Now, as the market has turned back down, we have seen these two ratios go down with it. Not to new lows, but they are going down with it. So that's suggesting that the short-term move to the downside in the S&P 500 is sustainable, that we're more than likely going to keep going lower. But my favorite ratio is the XLY XLP, and that one is on the verge of breaking out again. So once again, we have conflicting signals. I mean, I think it comes down partly to your bias. I'll admit that. I am definitely more bullish after what I saw back in June. Also, the sentiment numbers, which I talked about at the beginning of the year, saying they needed to reset. The market was going to go down because we needed sentiment to get bearish. Well, on that June low, we hit levels where we see major market bottoms form. It took us 5.5 months, but finally options traders caved in and said, okay, now we're bearish, right at the June bottom. Now we're bearish. The market's going to go down. And that's when the market started going back up. So we had more. It wasn't just this rotation. It was also finally getting sentiment to the point where everybody thinks the market's going to go down. That's usually when the market goes up. So we had this nice rally, which was beautiful. But with the rollover, with the Fed's comments from Jackson Hole, with the latest CPI news, you can see we're trending lower. And I'm not disputing that. We're trending lower. We got to get back through 3,900. I'd be very cautious until we can get back above 3,900, then the 20-day, then the 50-day. Now, the moving averages, I don't think are that big a deal. I think we carved out a bottom here, and I think we carved out a pretty significant short-term top there. I believe we're going to sideways consolidate and then break out above 4,300 at some point during the fourth quarter. That's what I think, but we'll see. Oh, and then this is, well, market just opened. Let's take a quick look and see what the market's doing here. So right now we got the Dow down 253, S&P down 34, NASDAQ down 110. We've seen this before. We see gap downs a lot. I've been telling members now for the last few months that the manipulation to me is very clear. A lot of the movement to the downside is via gaps. And then the balance of the day, especially once we get past about 10 in the morning or 11 in the morning, the balance of the day is actually pretty strong. I've got a stat here, which is kind of an interesting one. I've said it before, but if you weren't listening at that time, let me see if I can find it for you. So I updated the QQQ through, I think, last Thursday. Yeah, I didn't do Friday, but I did through last Thursday. And from November 19th, and this will be the last thing that I do. We'll wrap up with this. But let me pull up the QQQ for a year. So from this high right here, this is when the top occurred for the NASDAQ. This is kind of an important high for me. If you look at what happened from here to here, that's where we saw a lot of the rotation out of aggressive areas and into more defensive areas. So that was the period of sideways consolidation while all of the, a lot of the money was rotating on Wall Street from offense to defense. And then we followed it up with a lot of selling. Once we broke that double bottom, it was pretty much all over. I believe we started this process of rotation here. And I think we're still in this process of rotation. That's why I don't believe we're going to hold here, just like I didn't think that we were going to break out and continue going higher back at the end of December, early January. I feel the same way now, except in opposite. I feel like we've already bottomed. Yes, we might go down and test it, but I think there's a lot of rotation that's taken place. And I think the next big move is going to be the upside. I think we clear that high before we go below this low, my opinion. We'll see. But we are down intraday. But the QQQ from here, and I think it was from the November 19th high, which is like $401, to the September 15th low, which was $291, we lost a total, must have been $402 because we lost $111 on the QQQ. $111. Do you know what happened in the time period after 11 o'clock in the morning during this entire move to the downside? 111-point drop. The net of all trading days from 11 o'clock in the morning until 4 o'clock in the afternoon, QQQ went up $40. It went down $151 in gaps and in the first hour and a half of trading. And it rose $40 in the last 5 hours of trading. Now, some of you might say, well, I don't know what that means, or I don't care. Market went down. And that's fine. But I think it does matter in the sense of whether or not you believe it's a cyclical bear market versus a secular bear market. I don't believe in a secular bear market that would have been buying from 11 a.m. to 4 p.m. I just don't. I think you would have seen mostly, it would have been just like it was back in January. During this period right here, all times of the day we saw selling. I can give you the numbers from, and then I'll wrap up. Let's just wrap up with this. From let's do from January 4th right here to January 27th on the QQQ. We went down $60 during this move to the downside. $60 we lost. We lost $10.50 on the opening gap, net, cumulative. All these gaps went down $10.50. The first half hour of the trading day only went down like another $0.50. From 10 o'clock to 11 o'clock went down another $26. And from 11 o'clock through the balance of the day went down another $23. So this was the one period, right here. This was the one period where we saw selling all day long. After that, pretty much over. I mean, we saw selling I mean, you can see some big red candles, but just on a net basis, like this big move right here. Let me read this one to you. I swear this will be the last thing I do. From, what is that? The end of March. So March 30th, I actually don't have this broken out, so but I'll get it for you. So we're going to go from March 30th down to, let's just go all the way to June. So all the way to this June bottom. So March 30th to June 17th. So I've got to do those three. Just doing a real quick calculation. All right. So the opening gaps during that period. And let's see how much we went down total first. All right. So from here to here, we went down $96. From the March 31st. So I guess here on the Qs, it would have been somewhere around 365 down to 270. Yeah, it's about $96. Okay, so from here down to here, we went down $96. 39 at the opening gap, 48 in the first half hour of trading, 21 in the next hour of trading. And then over the last 5 hours of the trading day during this decline, during the last 5 hours of trading day, we went up $13 on the QQQ. I don't know. To me, that's not all out distribution. There are buyers in the last 5 hours. They're getting everyone. The media is talking up everything. It's negative. We gap down. We trade down in the morning, and then who in the heck is stepping up and buying? I mean, this is the part of the game, in my opinion, it's just not fair. I think you've got Wall Street firms going on, the analysts are on CNBC saying whatever, we're downgrading this, we don't like the market here, blah, 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 blah. Everybody's selling at the open, they're selling in the morning, and then in the afternoon, I think Wall Street firms are buying for their institutional clients, the market makers. Because if the market ends up going back to highs later, well, I don't think it's going to be later this year. I think it'll probably be next year. If the stock market goes back to new highs, whether institutions were buying the Q or all the individual stocks within the QQQ, if they were buying them back here or down here, it really doesn't matter when you're back up here. You're making money. And so I believe there's been a lot of accumulation. That's just my opinion. Anyway, I'm going to wrap up on that note. I know I've been a little long. Let's see, one last quick look at the market. Market coming back a little bit. Dow down 176, S&P down 23, NASDAQ down 65. The big thing is where we finish. I expect the market to be I think it'll start to calm down heading into the Fed. That's what it usually does. And it normally will gravitate to a key area right at about the time the Fed comes out with its announcement at 2 o'clock. I don't know what that number might be. I mean, maybe it's 3,900 on the S&P 500. I guess technically, maybe it's all the way back down 3,700. I mean, maybe we lose another 150 points. I don't feel like it's going back down there, but I don't know. It's possible. Anyway, I've probably confused you because I'm honestly a little bit confused here in the short term, watching the market to see whether or not we hold in here. Ratios are mixed. By the way, I've mentioned it in recent shows. This half of September is one of the worst periods of the year historically. So that's another reason why this is an opportunity for the bears. Historically, this is not good time. The July 17th close to the September 26th close is the worst period of the year. We're 10 days away from that ending. So here's your window. I'm just talking to the bears. This is your window. This is your opportunity. If you can't do it now with a higher inflation rate last week, with the Fed raising 75, maybe even 100, the worst time of the year, if it doesn't get done here, I don't think it gets done. Anyway, that's it for me. Happy trading, everybody.